So good morning, everybody, and welcome to this FX Street webinar, where today we're going to be talking about the failed breakout. And I've got here beat the banks. In reality, it's kind of beat all of the major institutions, but that just sounds a little bit more catchy. But ultimately, what we're going to be talking about today is how to take advantage of failed breakouts, because we all know that the markets trend, but we do know that the markets go into consolidation. And I did a little study on the markets a few weeks ago, and what I noticed was ultimately the volatility of the market for more than half in sort of like the last 4 or 5 years. And, because there are directional moves on a shorter term basis, but because there aren't like massive long-term directional moves going on at the moment, I thought giving you guys a strategy to take advantage of to be able to exploit the range-bound markets and the consolidation would be a good subject for today's webinar. So let's move on. So before we get started, the content of this webinar is not investment advice and should be used purely for educational purposes only. And you guys are all advised to seek your own counsel prior to investing or entering into any trade, because spread betting or financial trading carries a high level of risk to your capital. And you can read the rest of it, hopefully. All right. So a little bit about myself. My name's Alex Ong. I'm the co-founder of a company called Traders Corner. It's an education website. It's a website I run with my brother. We've been trading the markets roughly since about 2005, and we write articles for various different websites, different magazines. We've also been quoted on NASDAQ. And we're the co-author of, it's actually more than that now, a few strategy manuals, video courses, all of that kind of good stuff. So we do it all in a bid to help you guys achieve some profitability and kind of beat the markets and make some money at this game. If you want to follow me, I'm not as active on there, but if you want to follow me, you can, my Twitter handle is @AlexOngUK. That's enough about me. So about this system, beat the banks. What is this system? What are we talking about here exactly? Well, ultimately, we're looking to trade failed breakouts. Now, I know that, I would assume that many of you have tried breakout trading before. It seems like an easy way to go. And to be honest with you, at one point in time, it really was. You bracket a range, you buy above the top, sell below the bottom, and you'd be in. However, what's happening now is that you're getting into the trade, but there isn't enough momentum in the trade to take you to your profit targets. And what's happening a lot of the time is the markets are reversing back into the ranges. So what we're doing here is we're offering you an alternative strategy to trading the breakout. You can see what you think of it. So this can be executed on any time frame. However, we prefer executing them on a daily chart. Now, obviously, it's up to yourself. So if you want to trade 5-minute charts or 15-minute charts or whatever, you can apply the same strategies. However, you should know that the levels won't hold nearly as much weight. They won't be as strong as levels on the daily chart, for example. Now, this is a contrarian approach to playing breakouts. The majority of the market will get into, or retail traders anyway, will try and get into a trade where they're looking to get into the trade in the direction of the momentum, if you like. What we're doing here is we're looking to fade that momentum, fade that entry. So whereas many traders get torn up by false signals and breakouts, we will thrive on them with this system. It's indicator free. Okay, so there's no magic, magic cross or anything like that. It's literally a completely indicator free session, and it can be traded on any pair. Giraffe, hi, how are you? Nice to see you again. So let's move on. So first of all, let's try and understand why the breakouts fail, because this is important to having faith in the system. One of the things that my brother and I are always trying to ensure that our traders do is we want them to understand why a particular strategy works. We don't want it to be sort of just monkey see, monkey do. We want you guys to be confident enough in the strategy to be able to trade it through the bad times, because make no mistake, every strategy that you have will have bad times. There will be drawdowns. So what we need to do is have faith in our system enough to be able to trade through those bad times so that we get to the good times where we can make all of our money. All right. There is no holy grail. There is no magic system which is going to make you right 100 times out of 100. I'm sorry. It doesn't exist. However, you don't need that. If you can have a system that's right, 50 times out of 100, but you have a positive risk reward, you still make money. It really is as simple as that when you break it down to figures like that. So why do the breakouts fail? Well, the big levels, they require something significant to occur in order for them to be broken. All right. So what I'm trying to say here is that the bigger boys, the banks, the hedge funds, they have large positions. Unlike us as retail traders, okay, why does it beat the banks? Well, I'll get into that in a second, Joe. Okay, so the big boys, what they need to get into a position is that they need liquidity. Okay, whereas us as retail traders, we can get in and out very, very easily. Okay, we can get in at the drop of a hat with a few seconds because we're never going to trade a position that's big enough to cause the markets to move. Okay, there's always going to be liquidity. Now, what happens when traders for the big banks or the big hedge funds trying to get involved in multi-billion-dollar positions is that they're going to move the markets naturally. Okay, and what that means is that they're not going to get the sort of price that they would like. So they need to trade longer term, which is why I say that the big levels require something significant to occur in order for them to be broken, because the trends are in place, because the bigger banks have built into a position. They've decided on a direction for the markets to go, okay, that they would like, or they anticipate the markets going, and they need to build into their positions. Now, to build into the positions, they require liquidity. So if they were just to get in like you and I, and let's say, for example, they want to get in on the pound dollar going along at 16000, they could start getting in at that particular price, but they may end up getting in, much higher up at something like 161 or 16050. So they're going to give up, quite a few pips there in terms of possible profit, and also give themselves additional risks just by trying to get into positions if they don't think about how they structure it. Do you guys understand this so far? Do you see what I'm trying to say? Yeah? All right. So as a result, that's why the big levels require something quite significant to occur in order for them to be broken. So what the bigger boys do is that they use these bigger levels to entice, to seduce traders into trying to get in on the break of the big levels, knowing full well that they're going to fade them at those levels. So they will sort of push the markets up to those levels where you get a couple of things. So you'll get people trying to play the breakouts. You'll get stops behind the breakouts. I'll come to all of this in a second. And let's say, for example, that's a resistance area. All of that buying is going to provide liquidity for them to be able to sell. So if they want to sell at that particular level, let me just try and annotate this for a second. So we've got a market, okay, we've got a high here. Now, not a very straight line, but anyway, when the markets are coming up to this level, let's say, for example, the big trend is on the downside, okay, or this is a huge level, either way. The bigger players are going to have money invested in trying to get short. They may also want to try and get short some more, all right, so they want to get in on the pullback. Now, what they will do is that they will entice the traders that have got stops in at this level here they'll entice the traders that want to go long here to start to go long, and they will try and flush out all of the stops here by flushing out the stops. So if you were short here, they would need to buy, and in order to buy, they need someone to buy from, okay? So what happens is when the markets get to this sort of level and break through here, you have a whole lot of buy orders come into the market. And if you were one of the bigger banks or one of the bigger institutions, you would then mop up all of these buy orders in and around this area here to sell the market all the way back down. And that tends to be where we get our failed breakouts. Okay, so if you get a proper breakout, you're expecting a lot of momentum to come into the markets at the point of breakout. So really, you want a massive momentum move up to the upside like that. But what actually happens a lot of the time, not all the time, but a lot of the time, is the markets fail and get back into the range and continue on their merry way from whence they just came. All right? And the reason for that, as I said, is that ultimately the bigger institutions are using these levels here to entice traders to start buying at these levels. When they start buying at those levels, they can then sell to those buyers and push the market back down. Does that make sense to you guys? Are there any questions on that? So why else do these particular trade setups make sense? Well, the other things I said, market volatility has actually decreased significantly. So back in 2008, 2009, when the credit crunch was on, you had big moves that just literally went in one direction. You know, I remember taking a position of an evening, waking up the next morning and being 200 pips in profit over the Asian session. When has that ever happened before? Right? So anyway, we had these big directional moves, which were fantastic. However, over the past sort of 3, 4, 5 years, that volatility has decreased. So there isn't as much momentum in the market. There are also no clear winners in the market as of late. So what I mean by that is, whereas before, let's say, for example, the dollar yen, a massive carry trade pair. All right. So people would sell the yen, buy the dollar. Okay. So the dollar yen would increase in value. Now, there was a clear winner there. There was interest rate differentials. There were fundamentals behind the positions, and that would go in one direction. Fine. Wonderful. Today, you can't find one economy that's particularly better than the other. All of the economies out there, they're all struggling. Everybody's suffering from the same thing at the moment. Okay, so there's all of the big funds, they don't know where to take their positions. They can't position themselves for a major trend and everything. So what they need to do instead is that they need to exploit the consolidation. All right? Sorry, quick question here. Didn't understand how they need for a liquidity is linked to why they do this. What do you mean, Drav? Well, ultimately, they need to get into a position, okay, and they don't want to move the markets. All right, so if I take this again. So let's say, for example, we've got that sort of action coming on here. If they were to sell, just from here, if they were to sell when everybody else is selling, okay, they'd probably start selling here, and they'd get their whole position into the market somewhere down there, okay? However, if, got that same scenario going on there, if they can seduce and entice other traders to start buying at this level here, okay, they're not getting into a trade while there's a load of selling going on, meaning that they get into their position down here. They can start getting into their position and feeding the liquidity up here, which means that their average price might be somewhere around there, as opposed to all the way down over here. Do you see what I mean? Does that make sense? Okay, excellent. So, where am I? Why is there perception of euro doom, but it keeps within a good range? Because, okay, so there's a perception that the euro's doomed, pound fire, but the US isn't particularly looking great at the moment, is there? Are they? With their debt ceiling and everything. If they can't service their debt, they don't really look much better than that. Which kind of just goes to prove the theory there that there are no clear winners in this particular market. At the moment, your choice isn't who is the better currency pair. Your choice isn't which is the better economy. Your choice is which is the better looking of the two ugly sisters. Do you see what I mean? I don't mean that in a derogatory way, but... Okay, excellent. So this basically is just going to back up what I was just saying. So ultimately, you've got the markets that are pushing up to a particular level. You need a strong level, okay? We don't take these trades from miniature levels that really haven't had any sort of significant impact. We want levels where the markets have clearly turned around at, and I'll show you that in a second. So the market comes up to a particular level, comes back down, it breaks through a level. Now, what are the clues that we're looking for that this could be a failed breakout? Well, if this is going to be a successful breakout, you expect momentum in the direction of the breakout. So if people are buying here, and this is a true breakout, you're expecting it to move all the way up in this direction over here, okay? However, what's happening instead of a nice big move to the upside over here, which we don't get, you get a complete lack of momentum. The market comes down to this breakout level here. Instead of holding on this level, okay, because the other alternative is that the market breaks out, comes back to the level, holds above the level, and pushes off again. But instead of all of that, what we actually get is the market coming back below the level and closing below the level. That there is then a clue for us that actually, you know what, this particular setup here, it doesn't make much sense. It's unlikely that the market's going to continue to the upside. So instead what we're going to do is we're going to sell it, and we'll sell it down to either the next low, being this guy over here, or we can sell it further still. And as you can see, from taking these sorts of trades, you get a relatively good risk reward. So whereas maybe you put your stop above the high there, like so, you know, that's what, 1, so you probably got a nice 2 to 1 on that particular trade there for a relatively low risk trade. Is everybody still with me? You still alive? Still awake? Excellent. So how do we trade this? What is it that we're looking for? Well, ultimately, we're looking for a strong level. It has to be a strong level. We're not looking to trade weak levels, because weak levels don't mean anything. We need a significant level that the rest of the market are looking at. Okay, we want a big level that the bigger players can look at and say, yeah, this would make a good opportunity. This would make sense for us to get in here and take a position. We don't want those small levels where they think, well, there's no way we're ever going to have enough liquidity at this level, so there's no point in trading it. All right? We need to wait for the breakout. Once we get the breakout, we have to observe the breakout. So the breakout must show a clear lack of momentum. And I'll show you what I mean by that on the chart in a second. Once we get a lack of momentum, we then wait for the market to close below the breakout level or above it, you know, depending on which way it is, but basically behind it, close back inside the breakout level, if you like. Once it closes back inside, that's our first clue, but we're going to wait for a little bit more confirmation, and we'll wait for the breakout candle. Okay, so we'll wait for a break of the candle that closes inside the breakout area. Sorry, we've got work going on in the background now. Can you guys hear me okay? Yeah? Okay. So we enter on a break of the candle that closes back inside the breakout area. We place our stop behind the candle, or we place it behind the swing point. And then the take profit is completely down to your personality. All right? So if you're looking for a quick one-to-one, take one-to-one. If you're looking to trade it all the way back down to the next trouble area, to the next support or resistance point, then you can do that too. But it's a very, very simple strategy. There's literally not a lot to it. It's literally you're looking for strong levels. You need to learn how to identify strong levels. You wait for a breakout, clear lack of momentum. You wait for the market to close back within the breakout level, and then you're waiting to enter on the break of the candle that closes. So you guys know that my brother and I are very, very conservative. We don't like just jumping in just because we think something's going to happen. We like confirmation. We like proof. And that's the sort of proof that we're looking for. Does that make sense? Does anybody have any questions on that? No questions? Okay, so let's take a look at some examples. Now, the first thing that I said to you just now was that we need, this is the Aussie, yeah. All right, now, we need strong levels. We need levels that make sense. So this here represents a strong level. Why? Look at the reaction to the level. The first time the market comes down to it, it comes down to that particular level and it completely takes off from there. It doesn't go sideways, it takes off. So that's a strong level. All right. However, things like this here, this isn't a strong level. Why is that not a strong level? Because there's been no momentum down to that level. You want to see clear momentum down to a level and then a nice big reversal. All right. This particular level here, we get it twice. We get nice momentum down to that level and then another reversal. The market doesn't even look back. So the next time the market comes down to this level, and we're looking at this particular opportunity here, the next time the market comes down to that level there, we're going to be looking at it because we're going to be anticipating some sort of a reaction. Now, when the market gets below that level, our eyes are on it. We want the market to then close back above the level, proving to us that actually, number one, it's done a few things. Number one, it's acknowledged the level. Okay, so it sees the levels there. Number two, it's attempted to break out from the level. And number three, importantly, it's failed to break out from that level. When it fails to break out from the level, you then look to take the trade on the break of the candle high. So we'd be looking to enter around there with our stop below there. So the total risk on that trade is whatever that is there. The reward, you can do a couple of things. So you can go 1-to-1, 2-to-1, or you can trade it towards the next sort of high, which will be around that level there. Okay? And either way, you can see that you get massive risk reward. Now, what happens when a market does actually break out from a particular level? We'll take a look. This is what happens here. If you look right, see the reaction to this candle where the market's tried to get below it, it's failed, it's got back above. When the market is serious about getting through a level, it doesn't look back, it doesn't mess about. So it comes down to this level, it plays about with this level, all right? It doesn't close below it or anything like that. This one here, and then it literally smashes all the way back down. Whereas this one here, its attempt to break through the level, right there, is a failed attempt. This one, when it breaks the level, it doesn't look back. There's clear momentum to the downside. Nothing else to it. Gold at some point right now. Possibly. I haven't seen the chart recently, but yeah. What about the pound dollar? Well, who remembers this move? This was a great trade for us at the beginning of the year. Made a lot of money off the back of this trade here. Again, what happens? We have a big level. How do we know it's a big level? The market's come up to it. It's sold off massively. Look at that sell-off from that level there. So we know that level bears some sort of significance. The next time the market comes up to the level, can't get through it, sells off. The next time the market comes up to it, can't get through it, sells off. The next time the market comes up to it, it breaks through it. When it breaks through it, there is no momentum. Okay? There's no momentum to take it through. If this level is going to be broken, we'd expect a move up there. We don't get the move up there. It breaks through, it closes back below this particular level here, as you can see. And when it closes below the level, we get an almighty sell-off from that level. Do you see how these are very, very straightforward setups? They don't take a lot of thinking behind it. You just need to be patient because they don't happen every day. So if it breaks the level at great pace, we wouldn't enter on a break of the level. We're not looking to trade the breakout, Rocco. We're looking to trade the failed breakout. If the price retests level of support after breaking out, should we generally go long? Yeah, I mean, that's a different strategy. I've actually done a webinar on that for FX3 where if the market breaks out, comes out and retests the level, doesn't break through it, and then goes off. You see, that's the way that I would trade the breakout. I wouldn't trade the immediate breakout. I'd wait for the market to come back, retest the level, and then once it's confirmed the retest, then I would go long. That's my preferred way of doing it. And you know what? You could even use some of the strategies that we're teaching you here. So you could wait for the market to come back to this level, maybe break a bit below, but not close behind there, and then break back above this level. And that would give you confirmation that actually this level is dead now. The market wants to rally from that level. What you need to be doing is you need to read the markets and understand what the candles are telling you. Because the markets tell a story. You just have to be there and you need to be open enough to be able to read the story, to understand it. But 100%, the market leaves footprints. The market leaves clues. And we as traders, what we're attempting to do is we're acting as sort of detectives. So we pick up all of the clues, we build our case, and then we trade according to the case that we've just built up. That's all we're doing. We're not going to be right every time. You can't be right every time. But hopefully we're right enough of the time. Should we go look at another example? Yes? Okay, so another one of the pound dollar. Let's take a look at this one here. So the market's broken. This is that sell-off that we saw earlier, right? The market sold all the way off. It's come back to a level. It's given us a strong level. Why is this one strong and this one's not? All right. This one here, this one is not a strong level. Why? The sell-off is nowhere. That means nothing to the markets. We don't care about that level. This level is strong because you've got a nice pullback to it. You've got momentum to the level and you've got massive turnaround at that level. So the next time the market gets up to that level, it closes above the level, plays about, closes back below the level down here, you can then enter on the low of that candle there. And as you can see, even if you trade it down to the low there, you still got 1.5 to 1-ish if you place your stop above the high. Okay, now, as I said, we're trading these on daily charts, so they won't happen every day. But you need to make sure that you're there to be able to trade them when they do happen. You don't want to miss these particular trades. But this system is ideal for those of you who can't sit in front of the screen all day. For those of you who work regular 9-to-5 jobs, fantastic, no problem. Trade this system here. Do it on a daily basis. Every evening, come and take a look at your charts. It's clear what's happening. Okay, you're trading on the daily candles, on the close of the day candle. So you come in after 9:30 UK time. Once the US markets are open, you analyze your charts, you make your decisions based on that particular chart. Then you go away, and you come back the next day. Once you're into the flow of this, you'll know what's going on in the market, you'll know what you're waiting for, and you'll probably be able to check this out with 5 minutes of an evening. Just click, 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 click. Nothing's broken through, nothing's at a big level, you don't care. As I said, you may only get, trading this particular type of system, trading, 28, 30 pairs, you might only get, a handful of opportunities a month, but there'll be good opportunities. The other thing, this sort of a trading system here, this works equally as well for stocks and shares and equities and commodities. This is a very good trading system. It makes a lot of sense. You just have to be patient. Are there any questions so far? Okay, let's look at one more, which is the euro dollar. This is actually a couple of years ago. This is a very good trade there. So the market had bottomed out down here. The market had used this particular level previously as a level of resistance, not a big level of resistance. We look at it later on a daily time frame. Okay? It's not a huge level of resistance, but it's a level of resistance all the same. However, the market moves away, massive momentum move to the downside, and the market pulls away from it very nicely. Okay, it's not as big as the previous examples, but we like this particular one because the level is backed up previously over there. And if you go look left on the chart, it's also a very big level previously as well. I just can't get it in here. But it's a level that the market respects, or it is a strong level. The market comes back to that level, pulls away, comes back to that level again, attempts to break out from the level, closes below, can't get any further, closes back above over here. You get in with your trade there. You have your stop below the low there. You either go 1-to-1 for the highs there, or you go a little bit more for the highs over here, maybe 3-4-1 on your trade up there. Okay, and obviously because you're trading daily time frames, you want to make the most out of your trades when you can. So you want to try and trade to the next resistance level. Okay, or certainly within sort of 50 pips of that next resistance level. You said this can be done on any time frame, but you take these on the daily time frame. Yes, indeed, Gerald. Basically the strategies that we show you, they can be applied to anything. We like to apply it on the daily time frames because, as we said, we call this trading system beat the bank, liquidity trader. And the reason is that we're looking to get into the positions that the bigger boys are. They can't play with us at the lower levels there. On the lower levels, as kind of Pavlin just said, there's a lot more noise on the lower levels. On the daily levels, that's where the bigger boys are going to be looking at it. So the levels are going to hold a lot more weight. Okay? So are there any questions? What we'll do now is we'll open up the floor to some questions. Maybe take a look at a couple of charts and go from there. What about on the 4 hour? The 4 hour you could trade as well, Drav. As I said, you can apply it to any time frame. It just so happens that we feel more comfortable applying this to a daily time frame. And we would recommend it, particularly for new traders, to apply it to a daily time frame. Because as a new trader, what you need to do is you need to build confidence in your trading. All right? And to build confidence in your trading, you like a higher strike rate, and this will give you that. Right, just as good as daily to apply to, yes. Lesser noise there, exactly. So are there any other questions? Or are there any questions? Sorry, I'll open up the floor now to questions from you guys. If approaches with no momentum, what does that mean? Well, it depends what you're saying. So if it kind of meanders up to, it depends how big the level is. So on the euro, let's take, okay, euro here. Which level are you talking about? You're talking about this one over here on the weekly. Okay, let me bring up the weekly time frame. So you're talking about this level over here. We get to these highs here. This I would still take. So if the market gets above here, fails to get above and sells back below, which I'd fully expect it to do, then I'll be willing to take it down to at least these sorts of levels here. So on a weekly time frame, you might be able to get into, a 500, nearly 1,000 pip move off the failure of this particular level. So that would make sense to me. Okay? Move my chart back to the other screen. Okay. Are there any particular pairs that you guys want to take a look at to kind of try and nail this and really drill this home? This level here on the euro is quite significant. This is quite a big level. It's come up to this level once or twice before. It's now holding above that level. So you'd expect it to rally from this level here. However, if it doesn't, and the market, which, let's say, for example, there's the US managed to do something about their issues they're having, and it closes back below here, I'd fully expect the euro to then continue down to sort of the 30.96 type level. So I'm more inclined, as opposed to I'm expecting more than a rally from here, I'm expecting a breakdown below this level. And again, you could then trade that particular failure. Because the market's attempted to get above this level, there's absolutely no momentum at this level. If it then breaks down from this level, you'd expect it to go lower. Why is the dollar down on the US rally? What do you mean, Ben? Gold. I don't know if I've got a gold chart, if I've got a gold feed on this particular platform. Suresh, are there any others? You want a USD CAD. I'm not going to go down to lower time frames because I'm not going to I don't want to encourage you guys to go down to a lower time frame to start with. I want you guys to look at the higher time frames and get disciplined at the higher time frame. And then you can graduate down to the lower time frame. Okay, so you've got one of those, you've got such a trade here on the dollar CAD. You've missed it. You can't take it now. But that trade was this one here. So you take a look, it comes down to the level, breaks away from the level, comes back down. What happens? Closes below. The very, very next day, closes back above. Stop below the low there, and you're looking to take this either to this sort of area here or up to this area here. And your entry would be there-ish with a stop below there. So whichever level you're trading that up to, you've got a better than a 1-to-1 risk-reward ratio. So it represents a good opportunity there. Last night the US markets rallied, but yet the dollar tanked. Okay, because ultimately the dollar is also seen as a safe haven. So you've got this element, Ben, of risk on, risk off, right? So when risk is on, so when the stock markets are rallying, no one wants to hold, people are feeling riskier. So what they'll do is they'll get into riskier assets. And what they typically do is that means that they're coming out of the dollar. People fly to the dollar. They go to the dollar in times of uncertainty. That's why you kind of see the dollar rally when it's almost counterintuitive. It doesn't make any sense, right? So as Pavlin just said, they'll go for the safe haven pairs, and the dollar is the dollar is the world currency, right? So that is one of the safest places to be, or that's the way it's seen. But even gold is falling. I haven't seen a gold chart, Ben, so I couldn't comment. But Ben, the thing here, what I can see that you may be making the mistake of is that a lot of the times it seems to me like you're concerned with why the move is happening. As a trader, what you need to remember is that we don't really care why the move is happening. The fact that it's happening is enough for us. Do you see what I mean? So, and there's nothing wrong with the way that you want to understand what's going on in the markets. The problem is that you might find that you end up missing a lot of opportunities because you're trying to work out why something is happening rather than taking advantage of the trade. Does that make sense? As a trader, you want to take advantage of the trade. You can find out why it happened later. That's fine. But whilst the move is going on, whilst there's momentum in the market, I really couldn't care less as to the reason, as long as I'm in it and I'm making money. How long do you wait for before timing is a failed breakout? No, Drav, it doesn't have to be the same day. It can be a number of days. I mean, we just looked at the euro dollar. All we're looking for is we're looking for the market to get above a level and then fail at that level. So this here, from my perspective, we want to see that the markets have attempted to get out from this level. So even if this breaks down here, I'd still be willing to trade that to the downside. Because what the market is telling me, if we read the story of the market, it's saying, okay, this is a big level, we've got out above here. And it's got out above there with some momentum. You'd expect the next day here to push the charts up here. So after a move like that, you want to be somewhere up towards these highs at least within the next few days. However, what is that? Nearly 10 days on, the market still isn't at those highs. If it then breaks down from here, that's going to be a big indication that the market doesn't care about that particular level. Thoughts on the pound dollar? The pound dollar, let's see. At the moment, we need to wait for it to break through this level here. This is going to be the big level where we were at the beginning of the year. So we're basically coming back to the same place as we were at the beginning of the year. At the moment, there's nothing going on in the pound dollar for me. Pavlin, it tends just to be support and resistance. I don't mind trend line breakouts, but I would have trend line breakouts. I'd have failures for the market to break the trend line. So, for example, I would trade something more like this here. If the market broke below here, then broke back above, I'd be quite willing to take that to the upside. If it just breaks below the trend line, then I would require some sort of a retest of the level. So if it got down here, if the market broke through from this level and came back up, I would need it to I would need it to come back up and retest there, and I would be selling at some point around here on the retest rather than the initial break. Are there any other questions? So there's no such thing as it stayed too long above a level. No, it depends what it does at the level, Joel. Okay? It depends what it does at the level. So let's say, for example, we consider this a level. This over here. Let's just imagine you're saying, is this a level? This, if it broke back below here, I wouldn't consider that a failed breakout. Okay? This would not be a failed breakout. I'd be expecting a market to bounce off this level. And if anything, I would want a fail to get below that level and then move back above. However, if the market just breaks out and hovers around that level and then breaks back down, that's a very, very big indication. The market spent, 10 days above the level, 10 days trying to break above, and after all of that, it still doesn't manage to go any further. Well, in those circumstances, the market is telling you something. It's saying it doesn't want to be above that particular level. If it doesn't want to be above that level, it must go below the level and it must sell off from it. That's just the market dynamics. Make sense? Okay, are there any other questions at all? Draft the trendline breakout strategy. Now, all I was saying is that if the markets, so if I put this trendline in here, this is a completely separate webinar, by the way. But the way I would trade a trendline breakout is I wouldn't take the initial break of the trendline. That's just me. So I wouldn't be getting involved when the market broke below that level there. I would wait for the market to break below like that, then pull back a bit, perhaps to this sort of area here, and then give me a signal to go short, and I would be taking the short from around that level there and follow it all the way down. That would be the way that I traded that particular breakout, but that's just me. Thank you, Ben. Much appreciated. Can we take a look at the euro yen quickly? Of course we can. Let's bring it up. Okay. So the euro yen. Yes, that would be termed as a failed breakout. The market got above that level of huge momentum, failed to stay above, closed back below. You'd be in somewhere around there. Around here-ish. Stop above here. Oh, data series. No, thank you. Stop above there. And you'd be really looking for the market to come somewhere to either these lows over here or certainly that low there. So again, this represents an opportunity where you have a greater than a 1-to-1 risk reward. So trading these setups, even though you can see that they are very reliable, even if they weren't reliable, even if you've got, let's say, a 50% strike rate trading these setups, you can still make money. You can still come out ahead of the game because you're trading with a positive risk reward, something that makes sense. Okay, people. Well, thank you very much, Draft. Much appreciated. I look forward to seeing you on the next one. Thank you, everybody for attending this FX Street webinar. Thank you, FX Street, for having me on today. It's been a pleasure, as always. If you guys have got any questions whatsoever, please feel free to email us. I'll put our support email in the chat box there. So support at traderscorner-online.com. Support at traderscorner-online.com. If you've got any questions whatsoever, please feel free to drop us a mail. Otherwise, thank you for attending, and I look forward to speaking to you all on the very next webinar, which I think is in Friday in 2 weeks' time. Again, FX Street, thank you very much for having us. It's been an absolute pleasure, and I will speak to you all very soon. Okay? So take care now, and good trading.